All right, well, why don't we go ahead and get started, if you wouldn't mind? You should be able to see Kent Jarvie's slides on screen. Also, Kent Jarvie's beautiful face, my not so beautiful face, and a very still image of Tara Christman. Tara Christman is my EA. She arranges and coordinates all this. Tara is on vacation this week. So Tara is actually Jay from our team, who is the admin for this webinar. Let me go ahead and make an introduction, give you a couple of instructions, and we'll get started again. We want to be mindful of your time. So this is a monthly web class that's offered pro bono by Preferred CFO as part of our partnership with Vistage. Participants are generally Vistage members or Vistage guests, and we're privileged to be a partner and a sponsor with Vistage, that relationship going back many, many, many years. I mentioned Jay, we are admin for today's meeting, even though he has the fortune of having Tara's picture up there for his image. So today's topic is future ready, preparing your business today for a high value exit tomorrow. Our presenter today will be Kent Jarvie. He is one of the great CFOs from our team. Kent is really known for a number of things. He has a tremendous entrepreneurial spirit, and that helps him with so many of our clients that are in growth mode or in startup mode or just trying to be entrepreneurs and be more entrepreneurial themselves. He has successfully guided startups and also high growth companies through strategic planning, through capital raises, and through successful exits and various other mergers and acquisition transactions. So this is intended to be about a 40 to 50-minute presentation. Please use the Q&A feature first. So Jay and I will monitor and consolidate the questions. If you have specific questions about how this applies to you, we are more than happy to give you some pro bono one-on-one time, and you can find that link or submit your contact information in chat. So again, you've got a Q&A feature to ask questions. If you'd like to make direct contact with me and set some time for myself or one of the other members of our team to follow up with you, we are happy to do that. Again, there's no cost for these classes. They are being recorded, and they will be offered the recording in the future. So again, find your Q&A button, find your chat button, and with that, I'm going to turn the time over to Mr. Kent Jarvie.
Well, thank you, Scott and Jay, and welcome everyone. Thank you for being here. My name is Kent Jarvie. Today's topic, preparing your business today for a high-value exit tomorrow. So over my career, I've served as CFO for numerous venture capital-backed companies where the focus was always on growth, scale, and ultimately a successful exit. I've been through many exits firsthand. Some were smoother than others, and I've seen what really drives value in the eyes of buyers and investors. While you often can't predict the exact timing of your exit, you can be prepared. High-value exits aren't easy. Your buyer will likely have a banker or a due diligence team whose job is to find the cracks, and your job is to fix those cracks before you engage them. And that starts by understanding right now what actually creates real exit value and what tends to hold it back. Actions taken today can significantly shape the outcome of your future. The most successful exits don't happen by chance. They're the result of thoughtful planning, often years in advance. Waiting until you're ready to sell is often too late. By then, it's hard to fix messy financials, reduce client concentration, or delegate mission-critical management roles. The reality is only 20 to 30% of lower middle market companies sell on favorable terms or even sell at all. And what I mean by lower middle market companies is less than 100 million in revenue. Companies that run smoothly without a heavy owner involvement tend to command higher valuations. The buyer expects to see a full management team which you need to start building today. And buyers, they'll pay a premium if the business offers predictability, scalability, and operational excellence. These traits reduce risk and increase values. The buyers place a high value on a business they can step into that's running well, not one they have to fix or rescue. Not all exits are the same. Different types of buyers may view the company differently. A strategic buyer, like a competitor, may value your brand and customers. A private equity firm wants EBITDA growth potential. An internal buyer, like a buyout, a management buyout, wants a manageable transaction. And yes, IPO, rare, but it is an exit path. So think about your most likely buyers and how you should prepare for each of them. The key drivers of valuation multiples that the buyers will use are EBITDA, quality and predictability, recurring revenue and customer retention, customer concentration, growth trajectory, operational scalability, team depth, and leadership. The buyers are thinking about risk and return, and they will evaluate your business based on this list. They pay premiums for consistency, predictability, and growth potential. If your revenue is lumpy, if your team is thin, or if the founder is still mission critical, that risk reduces value. For most buyers, the key valuation is EBITDA. So as a company and as a management team, measure it on a regular basis to see if you are in fact growing the value of the company. There are other ROI metrics that buyers may use depending on your industry, return on assets, return on equity, and improving gross margin, but this is primarily the list. There are 6 core areas that buyers evaluate closely: financial quality, operational scalability, customer diversification, team and leadership, market positioning, and legal and compliance. Let's go through each of these. Number 1, financial quality. GAAP compliant, clean financials. Now, you don't necessarily have to have audited financials. Buyers will be okay with unaudited financials, but there are caveats. The business must be solid, and some buyers rely on a third-party quality of earnings report, which digs into EBITDA, looks at revenue trends, looks at customer concentrations, and this report offers a more operational insight than even an audit. And lastly, if there's a high trust in the CFO or controller that's a credible financial leader with organized reporting, that's also very meaningful. They'll look at the financials, your historical and your forecast, budget versus actual. They'll slice and dice this and do tons of analysis around this, looking primarily at revenues and profits. They'll be asking, based on the historical and what they know to date about your company, is your revenue forecast credible, right? Because that's where the valuation is going to be calculated. And once again, on the revenue side, they'll slice and dice by segment, by customer, by product. So assume you're in diligence right now. Could you stand behind every number? Number 2, operational scalability. Lose the spreadsheets. You need automated real-time reporting. Automate and document your systems and processes today so you can scale. This allows you to manage proactively, not reactively. The more your business runs on systems and not people, the more valuable it becomes. Documented financial and operational processes and standard operating procedures are very important. They reduce key person risk and increase repeatability. Clear visibility into margins and productivity. The analysis and the evaluation of the company will start with gross margin of your customers, like how profitable is each customer, or your product line. Then the focus will shift to EBITDA and operating expenses. Is the company being run efficiently? Are these operating expenses at the right level? Because every dollar saved in operating expenses goes to EBITDA. So buyers want confidence where the value is created. And you need systems that scale without adding headcount or very little headcount. Ask yourself, can your business double in size without doubling your cost base? This is the essence of operational efficiency. You can't still be relying on tribal knowledge or manual processes or ad hoc processes when you engage a buyer. Number 3, customer diversification. The top 10 clients need to be less than 30% of revenue. And everyone will have their metric for this, but generally that's the case. Overdependence on a few large clients can kill deals or drive down price. 8 months ago, one of my clients, a professional services firm, they were approached by a buyer. Everyone was excited. And once they got into diligence, they had 42% of their revenue from one customer, and the client walked away, or the buyer walked away, because the obvious question, what happens if you lose that customer? There goes over 40% of your revenue. Buyers look for durable revenue from a wide, loyal base. They want high retention and low churn of customers. They want contract terms, customer lifetime value, and customer acquisition costs analyzed, and all of this matters. 4, team and leadership. Owners, they're always involved to a degree in the business, but you should be building a business that runs without you. Clear org structure, defined ownership of key functions, and accountability are essential. Buyers want to know that the leadership team is capable, committed, and incentivized to stay. This gives buyers confidence that the company won't fall apart after the close. Number 5, market positioning. Do you have a clear niche or a well-defined competitive advantage? Buyers want focus. They don't want we do everything. What makes your business stand out? What makes it unique? Large and growing market with room to scale. Do a total available market analysis. That's important. You need a strong growth narrative backed by metrics. Buyers are betting on future upside, not just past performance. A credible growth story grounded in numbers like revenue growth, margin expansion, etc., is also an important story to develop. You need a defensible brand IP or a unique offering. This protects margins and market share and gives buyers confidence in the company and its assets. Number 6, legal and compliance. Nothing spooks buyers like legal messes. Clean up IP ownership, ensure contracts are assignable, and confirm you're compliant across states and tax jurisdictions. These are easy to fix early and expensive to fix late. We've mentioned some of these before, but worth repeating because they absolutely will kill value or derail a deal. Hard to scale if a business is hard to scale or sell, if the business revolves around one person. You really need a full management team in place. Surprise liabilities uncovered during diligence, tax, legal, HR, contractual landmines scare buyers, and drop the price. Unclean books or unclear ownership creates friction and risk. Heavy reliance on a few clients is a major red flag. And deferred legal, HR, or compliance issues need to be cleaned up. these pitfalls, all of them can be addressed well before a sale process starts, but only if you think ahead. What to start doing today? Run a mock diligence process. Simulate the diligence process buyers will put you through. Are your financials defensible? Are client contracts assignable, etc.? Build a list of files to put in a data room. Make sure you have them ready. You'll have to update them later, but at least you know the list of files. You've started a room. Every company I join as CFO or with my clients, I start building the data room right away. So if we get approached, that's all in place. I just need to update it and I'm ready to go. You don't want to be scrambling during the deal process, which is usually under tight timelines and high stakes. You need to align your KPIs to value drivers that we've mentioned: retention, margin, and growth. You need a management dashboard, your whole team focused on those key KPIs that are linked to the value drivers. So over time, you're sure that you're creating value. And you want to shift from reactive to proactive finance. Always be looking ahead, looking at the trends. You don't need to overhaul everything overnight, but get started today. Act like you're always preparing for an exit, and you'll be ready when the opportunity comes. Final thoughts. High-value exits are built years in advance. Start planning your exit now, while you still have control and the luxury of time. Run it like you'll own it forever, but build it like you'll sell it tomorrow. Build your business to last. That means strong fundamentals, clean financials, repeatable processes, and a leadership team that can carry the company forward. Be exit ready before you need to be. And when the time comes to exit, your future buyer will thank you. You'll be handing them a business that's clear, scalable, and resilient. That's how you turn years of hard work into generational value. Don't wait for the sale to start preparing. Build something worth buying today so you can exit at a high value tomorrow. Any questions? You're Scott, you're on mute.
There you go. Thank you. I say Jay and I have been monitoring the Q&A. Let me just get with him to make sure we've consolidated the questions. But you had one comment, and that's I think I got it correctly, the proactive versus the reactive finance when it comes to managing your business. Did I get that right? And maybe elaborate on that just a little bit. Proactive versus reactive.
Yeah, exactly. You want to, through your forecasts and your forecasting scenarios from the historical data, you want to, use that to project the go forward. But being proactive means you're always out front looking at trends and understanding how the business is running. Reactive is not doing any of that and then closing your books and seeing that you have a problem. You should have anticipated that problem well in advance when it comes to maybe a shortfall in revenue, or maybe you were hiring and maybe you accelerated some hiring. So you should be expecting maybe some lower profits in the short run, but then be looking for a pickup in revenue down the road because you're, investing in more resources. So that's being proactive.
Okay. Good. And so there's a couple of questions here about how do you build a business to sell versus build the business to own? And I know you use the term, you want to build it like you're going to own it forever, but also be really like you're going to sell it tomorrow. There's got to be a difference, though, in the way you run your business today if you know you're going to own it 5 years from now versus if you're going to have sold it in 2 years. Is that true?
There's definitely a difference. I don't think the right approach is to build a business to sell it.
Okay.
you're just not, I mean, the point of this is how do you get a high value, right? And so I guess you could sell it for something, but you really want to build it for the long haul. And, uh, per my list of everything I mentioned, that's important to a buyer and trying to maximize, your exit value. I have clients, they're working hard at this, and now I have them focused on this presentation so that they're ready for that approach by a potential buyer and an exit.
Yep. Good. Thank you. I just had a comment come in. Exit planning is just good business planning. That's a good summary. I won't name who put that up, but one of our participants. Yeah, I think that was a great statement there, and that is exit planning is just good business planning. We have a lot of clients, probably slightly more than half that are planning an exit, which is, one of the reasons why they would have reached out to us for a fractional CFO. And their timeframes differ dramatically from the next 3 months to somewhere down the road, 3 to 5 years. If they, just as far as a thought process about investing cash or resources, if you were a manufacturing company and you were going to buy a piece of equipment that had a 20-year life value, 20-year life cycle on this piece of equipment, and you were going to buy it today, and you knew you were going to sell your business in the next 3 to 5 years, would you make that investment knowing that the last potentially 3/4 of this machine's life would belong to the new buyers, or would you make your current piece of equipment limp along and preserve that cash? Is there a mindset difference when it comes to sell your business?
No, because I think the priority is to grow the business. So that investment, you've made the determination that it's required to do that and that the company needs it. And I understand your comment, but you just don't know the timing of these events. And you don't want to be a year down the road and say, geez, I wish I really needed that equipment. So it's just too hard to predict. I think the default decision is always, how do I grow my company and what's the best investment of cash and other resources today to do that?
Okay, perfect. Thank you. Another comment come in from a comment rather than a question come in that says, as you had stated, you can't wait for the market to be sell ready before you start addressing getting the business ready for sale. If you do, you will assuredly miss the window or else be forced to sell a fixer upper. So, yeah, I think that's part of being athletic.
Yeah.
Kent, your opinion, we've got roughly 70 people on our team. I think I'd find some different opinions here. How important is a forecast, not just thrown together at the time of sale to say, here's what we think our business is going to do in the future, but a company that has been working their forecast and their budgets, and they have a track record that says, here's what we were going to do and we did it. Here's what we're going to do and we did it. Here's what we're going to do and we did it. And here's our forecast, our plan for the next 3 to 5 years. Is that, I see value in being more strategic in their decision making, so they'll build a better business with that forecast and plan. What is your experience in how that benefits a company at time of sell?
That's all important. So,
Okay.
I mean, it's all about the revenue, and that's the future of the company, and that's the growth of the company, and that's the profitability of the company. And if you have a history and you can point to the history of how you need to develop the revenue from the bottom up. So, you could have a direct sales company and maybe your best metric is, number of sales deals per quarter at an assumed average selling price, but that has to be backed up by actual data, historical data. And then that gives you the credibility for your forecast going forward, but it has to be built up and detailed and it's going to be evaluated. If you really can't speak to the parameters that drive the revenue forecast, it's you're just going to be not as credible as you could have been.
Yeah, I had Ken, I had a CEO of a company, Vistage member company in Texas. I know where, but I won't identify it any more than that, that described his exit, a couple of $100 million exit from his company. And the way he described the process was it was defending your life. So the buyers and the buyers agents were just doing everything they could to discredit any aspect of his company in order to reduce the price. And he said they got into the financial side of the company and they started asking questions that he said quite admittedly were below my level of confidence historically. And he said, hold on a sec here. I need to bring in my CFO. And he said, my CFO came into these discussions, negotiations about the sale of my business and its value. And he was my, quote, expert witness on the financials of my company. Have you experienced that before?
Well, I have in terms of, the buyer scrutiny on the numbers. And, uh, I don't want to repeat myself, but, either when you're presenting the numbers to sophisticated individuals, keep in mind, they probably hired a banker and so forth, and they're going to dive in, and they'll just know. They'll decide if it's credible, and if it's not credible, you'll get a low value or no value.
Yeah. For a mid-sized and small and mid-sized company, and let's just say $30 million or less, and we could maybe expand that. How common is it for the buyers? I mean, we need to look at it as PE versus strategic, but how common is it for the buyers to want the principal or the founder, the CEO, to remain for a period of time, at least 12 months, maybe 24 to 36?
Yeah, that's very common. It's many times required, and usually all the parties want to do that. The founder or owners, they want to be involved in the integration, the transition into the new company, and help that company be successful with the people that they're getting and the business itself. And many times, there could be an equity piece for that owner in the new company. So, and that's the smart thing to do, is to line all of the interests and incentives post-close, so that you can continue the momentum you had prior to close.
Okay, very good. I had a few questions about timing. I'm going to try and consolidate it maybe into one or two, but in your experience, to have an exit that the sellers will look back on and not have any regrets. And I think that's such an important concept, is you want to exit your business and live out whatever you have planned after that and do so without any regret that you could have, should have done it differently or better. So let's lay that foundation. But coming back to the questions, is there a minimum time frame that somebody should say, yeah, I want to sell my company to realistic to make a good no regrets exit?
Yeah, it has to be a well-run business that's operating on its own with certain levels of sophistication, like I mentioned, the management team, all the processes, and whatever amount of time that takes. And I've always wanted, when a buyer is looking at one of my companies, I want it to be successful as well. I want it to be successful for the employees that are going into the new company. And, in a way, we're all in it together. And, I think that's where the focus should be. And timing is too hard to pin down. I think exits just happened. A couple of mine exits were just immediate, and we didn't see it coming. And all of a sudden the two CEOs hit it off. They talked strategy. They said, we got to do this. The buyer had plenty of money lined up because he wanted to make an acquisition in our marketplace. And it all happened very quickly. But frankly, for that one, I was ready.
Yeah, I think it comes down, though, Kent, to what your last line there is: be exit ready before you need to be.
Yeah.
Um, I again, I don't want to take time away from you, but I had an experience in the last couple of years. So I'm a Vistage member, and uh, about God, what's it been? About 2 years, a little over 2 years ago now, I was introduced to a member of another my same chairs group, a different group, and he shared with me that. He has a very successful SaaS company, about $30 million in recurring revenue, very, very, very profitable. And he was the founder, CEO, and he'd just been diagnosed with prostate cancer. And he was going to go through all the treatments, but it was advanced. And our common chair put us in touch with each other. And I'm a prostate cancer survivor myself, 10 years. So he and I connected on that number of other points. And I said, yeah, he says, I need to prepare my business to sell. I've postponed this decision, but it's my 401k that I hope to enjoy and my wife's 401k. And I said, yeah, we can help you do that. And this was like earlier in the year. And then I didn't hear from him. I couldn't contact him. The chair just said, be patient. He's working through his treatments and issues. And we contacted him. We had another conversation in mid-December. And he told me that he'd gone through the treatments. The treatments had not been successful. He had spent the prior 30 days on the couch, unable to get off of the couch physically. And the doctor had given him 1 year to live. This was mid-December. He passed away 3 weeks later in early January of a heart attack, and unprepared. And so it took a tiger team to salvage his business. This is the worst case example that I've experienced, and we've heard a lot of stories about be exit ready before you need to be. So let's see, what other questions do we have? I've had a couple of requests to set up a time to meet. I'll send back each of you my contact information. Is there a time that's I'm looking at the last of the questions here, Ken. Is there a time that's too long to begin to prepare, or is that such a unusual question that if you're always preparing to build and you're always preparing to grow and you're always preparing to exit? Is that the right answer?
The right answer is, with everything I mentioned, it's kind of like all of those along the way you want to be putting it in place, right? And there will be different times where one is more important than the other. It's just having that mentality and knowing that it makes a difference. I mean, just simply that. But you just should be aware that you've spent 10, 20, 30 years building this business, and you don't want to get all the way up to meeting a potential buyer and get a low valuation because you weren't ready for it. It just should be a mentality that you have today and over time put in place these things that I've presented today.
Yeah. Okay. Just be ever ready, right?
Ever ready. I like that.
Okay. All right, I think we have summarized or encapsulated all the questions. Last call, if there's any more, put them into Q&A. I've got a couple of more people to contact through chat that have reached out to me directly. I'll send that. So if you've asked and haven't heard back from me, please hang on for just a minute. Jay, I don't see any other questions come through Q&A, so I think we are good. Let me give you the schedule for upcoming webinars. They're always the last Monday of the month, and they're at 5 o'clock Eastern, 4 o'clock Central, 3 o'clock Mountain, 2 o'clock Pacific. So the next one coming up will be Monday, the 27th of July, and the title is KPI and Metrics Strategy. Will be presented by another one of our great CFOs, Mr. Fred Patton. So, Kent, thank you very much for your time. Thank you for sharing your wisdom. I know it's hard to do when you can't get any feedback, but thank you for being prepared. I'll throw back into chat just some general information in case you want to be able to reach out to us, in case you want copies of the slides or anything related to that. And those that have reached out to me directly wanting me to contact them, hopefully you've gotten a response back already through chat. Thank you very much for your time. Have a great holiday as it's coming up this week. And let me put this in the chat here real quick. I give it to everyone. Perfect. Again, thank you very much. Jay, I think we're done here. Thank you for your help, Jay.
Yeah, of course. Thank you.
And by the way, yeah, you make an excellent Tara.
I try. I try. Thank you.
Thanks, everybody. Hey, Lauren, I notice you're still on here. Did you get the information you need? I think you're probably muted. It should be in chat. If you've got it, go ahead and drop off, and I'll assume we're connected. If not, you can always respond to the email with the invitation. You were one of the group that asked for my contact information, so hopefully you received that. Come back, Lauren. All right. Thanks, Jay.